Hello guys, welcome back to another video with the numbers guy from Phoenix Financial Training Dubai. Today's topic is very interesting. Lots and lots of questions have been asked to me about this topic, being IAS 1 presentation of financial statements. Now many times students tell me, why is the presentation of financial statements so important? That's what we are going to discuss today. Now, looking at the statement of profit or loss and statement of financial position, I get these questions all the time that what difference does it make if I add an income in the statement of profit or loss or in the statement of other comprehensive income? The total comprehensive income will be the same. So what difference does it make where I put it in this statement? Many times they also ask me, what difference does it make if I add an asset as non-current asset or a current asset? Or why can I not add a non-current liability as a current liability? The effect on equity is the same. Total liabilities will be the same. What's the difference? So to understand the statement of profit or loss and other comprehensive income, first, remember that guys, in the statement of profit or loss, which is the statement till profit for the year, we only have realized incomes and expenses in this part of the statement. And in the statement of other comprehensive income, which you can either have it as part of the same statement, or the accounting standards even allow you to have the OCI, the other comprehensive income, you can also have that as an independent separate statement. Now in the OCI statement, we only record the unrealized gains and losses. I like to say these gains and losses happen in the background as the company exists. So the thing is, it does matter if you move an item from the P&L to the OCI. Now, how does that matter? Consider the example of Richard. Let's say Richard is a director and he gets 10% of the company's net profit as part of the remuneration package. Looking at the items of the company's P&L, if Richard is allowed to move items from the P&L to the OCI randomly, then in one of the years he can literally say that he wants to move one of the operating expenses in the OCI. This will move one of the realized expenses to unrealized. It will increase the profit for the year of the company, and it will also put more money in Richard's pocket. Now companies can also do this to enhance their performance from one year to the other if they are given the option to do this. Not just that, how will you compare the financial statements of 2 years if within the P&L or within the P&L and OCI you keep moving items randomly? This is why they locked the presentation and they said you can't do that. Now imagine the statement of financial position. If let's say one of the liabilities are recorded as a non-current liability, whereas they are due to be paid within the next 12 months, then that is also misrepresentation. Now consider this example where Richard negotiated a 5-year loan in 2022. But if gearing covenants were breached, that loan would become repayable in 2024. Let's assume we are reporting for the year 2023. We need to establish if this loan is supposed to be a non-current liability or current. Imagine that the loan covenants have been breached and this loan has to be paid in the year 2024. This means the company should have cash to meet that obligation. Showing it as a non-current liability would be a massive miscommunication, which would suggest that this amount of money is not due anytime soon. And the shareholders would not worry about that payment to be made, and they will not check if the company has enough cash or not because they think this payment is not even due yet. And the companies, obviously, they want to motivate all the time that no, liabilities are not due very soon. Liabilities are not due very soon. They're positive. They're like, no, the loan covenants will not be breached. But the accountant has to see the actual reality and decide, is it a current liability or non-current? Because it matters. Guys, if the liability is current and you're presenting it as a non-current liability and the company does not have cash with them, then you're obviously, and I think you're ultimately hiding a potential going concern issue. An investor might invest their money in the company today without knowing that this company is heading straight to the wall. So 100%. Now ask me again, does it matter if I show this liability as current and non-current? 100% it does. Your audit report can even get qualified if you misrepresent at this point. Now, talking about the idea of recycling an item to the P&L. What is this recycling? Students ask me all the time. Guys, when you present an item in the OCI, it has a separate account in the equity section of the company, a separate pocket in the equity section of the company. Talking about revaluation of PPE, that will have a separate reserve, a separate account in the equity section. And for example, talking about the forex gains or cumulative gains or losses that you've had on the translation of the foreign subsidiary, they would also have a separate reserve in the equity section. Now what happens is the balances of these reserves in some cases can be shown back in the P&L. Take the example of revaluation of PPE. The reason I put this in red is, guys, because the cumulative gains or losses on your PPE can never be recycled back to the P&L. Meaning, once you sell your asset away, any balances remaining in the revaluation reserve related to those assets are transferred to the retained earnings, which is, by the way, another equity item. It is never shown back in the P&L. Now, to contrast, talking about the cumulative gains or losses that you would have on the retranslation of a foreign subsidiary, once you get rid of the subsidiary, any cumulative amount that you have, the closing balance on this reserve, it can be recycled back, meaning it can be shown back in the statement of profit or loss as a profit or cumulative loss, whatever it might be, in the year that you get rid of the subsidiary. I know many students criticize this by saying, but this is not the true performance of the company. Profits are being improved unnaturally. That makes sense. That is a criticism of the accounting standard, but this is allowed. And this is the idea of recycling. With that in mind, many times students get confused of a specific item which basically belongs in the P&L, but students always think that it is an OCI item. It is the fair value gains or losses related to investment property. I had to address this because I don't know why. Many times students think if you use the fair value model for investment property, then the gains or losses related to that are also shown in the OCI. They confuse it with the revaluation model of PPE, but that's not the case. Remember, for fair value model, guys, because we are only holding this property for capital appreciation, we are only holding this property for some sort of a rental income, we have a temporary view with this property. It's not our PPE which we're going to use till the end of our business, right? Or it's not a PPE with which we have a long-term intention. This is why any gains or losses related to your investment property under fair value model can be shown in the statement of profit or loss, or should be shown in the statement of profit or loss. Now, having said that, I hope it helped you out. I will see you very soon again in another video. Till then, this is me signing out.